So I just want to share one thing with y'all, and that is the volatility index. Can you guys see this?
Yep.
Okay, so volatility index represents the volatility in the S&P 500, and it can be very insightful. And so there are three levels of the volatility index to keep an eye on, and I think also can be a very strong indicator from a broad point of view of when things are bullish, when things are not, and when things are really bad. And so we have three areas. We have the investable bucket. And typically when the VIX is below roughly 18, 19, below that, markets in particular, the S&P 500 is more bullish. There's more upside movement in the S&P, and pretty much that big, as Mark has pointed out, the Mag 7, which represent 35% of the movement at present time. You get in above 18, between 27, and you get into what I call the chop bucket. This is when volatility moves around a lot and people start to anticipate, oh, it's going to go, volatility is going to suppress or go back down, and they end up getting basically whipshawed in a sense. And so this is a very cautionary environment. And then 27 and above, this is what I call the F bucket. This is where recessions happen, where markets spike. As you can see here, I'm going to go out to a weekly chart here. You can see when we this was back in August, we had a big spike, very big spike in the VIX. You get into 2020, 2020 or 22, we saw a lot of volatility in the market during these different weeks. And of course, February of 2020, we saw volatility spike and we saw the S&P sell off. And you can go through really sort of history and see where things get real choppy. If you're a long only investor, what you want is to have the VIX below 18, and that's when you see the S&P go up and the underlying stocks typically go up. But once you get in this chop bucket, this becomes questionable. Now there's opportunity there if you're willing to take the risk to do so. When you get up into this 20 near 27, today we're at the 24 mark. And there's a very good possibility we will see it start to reside back down towards the investable bucket. And those can be great opportunities to pick up stocks at the bottom, like, for instance, the Mag 7. But take into account the headline news that's driving a lot of this was tariffs, the Ukraine talks, those kind of things. You got to take that into account. You just can't focus on one indicator to determine what you're doing because there are other variables. But I think I use this quite a bit as a indicator of where volatility is going. Remember the options market, which has become an enormous market over the last 5 years with the introduction of 0 days to expiration options. Volatility is an option trader's friend. They want to see volatility because it moves option contracts up and down very drastically. So as we are in this chop bucket phase, this is a cautionary sign to me. If you're a long only investor, this is when you don't start going, hey, I'm going to start buying at the bottom, because we honestly, in this environment, we don't know if we're in a bottoming period. We could easily spike into the F bucket, and that could easily be sizable losses. So be careful here. Once we see things recede back into the investable bucket, that's when there's a very good opportunity to possibly pick up stocks at a cheap price and be able to have opportunity for upward movement, both on a short-term but also on a long-term basis. So that I wanted to share that because I think this is going to become more and more in the next 30 days or so, more and more important, especially with the presidential administration's approach to getting things to reset and getting prices to more reasonable prices, and also instilling confidence back into government assets as well. So I wanted to share that with you. So we'll open it up to the floor here.